Hello everyone, I am Dr. Kshitija. Today we are going to discuss one of the important concept of cash flow statement, that is net profit before tax and extraordinary items. So let's start. In the previous video we have taken basic information about the cash flow statement. As we know, as per the accounting standard 3, an enterprise should report cash flow from operating activities either by using direct method or indirect method. First, we'll consider direct method. Profit and loss account is prepared on the basis of cash and accrual. But in case of direct method, we consider only the cash transactions. For example, cash receipts from customer, cash payments to the suppliers, purchases, cash expenses. Under this method, non-cash and non-operating items are not taken into consideration. For example, depreciation, discount on shares, interest received, dividend paid. So let's see the format of cash flows from operating activities under direct method. Cash receipt from customer, then cash paid to the supplier and employees is deducted. We can get cash generated from operations. After that, we deduct the income tax payment. We get cash flow before extraordinary items. Add, addition or subtraction of extraordinary items. Finally, we get net cash from operating activities. But generally, this method is not used. For the syllabus purpose, we have to solve problems on the basis of indirect method. Under this method, cash flow statement is prepared considering cash flow from three activities, which are operating activities, investing activities and financing activities. Dear students, while calculating cash flow from operating activities, we should take into consideration net profit or loss, because statement of profit and loss incorporates all the operating activities. Profit is calculated on accrual basis, not on cash basis. Statement of profit and loss includes non-cash activities, also non-operating activities. Therefore, it is necessary to adjust profit and loss while calculating cash flow from operations. Let's try to understand the concept of non-cash activities. These are the activities in which no cash is involved. For example, depreciation, amortization, depletion, stock-based compensation and asset impairments. These activities reduces the earnings, but there is no cash flow involved. Next is non-operating activities. These are the activities which are unrelated or which are not related to the core operations of the business. These includes expenses like interest payments or costs from currency exchanges. Non-operating expenses are deducted from the operating profit. How to calculate net profit or loss before tax and extraordinary items? First, we take into consideration net profit, which we can get through profit and loss account. If profit and loss account is not given in the problem, then we should take difference between closing balance and opening balance of profit and loss account, which is given in the balance sheet. When we prepare or when we calculate net profit through profit and loss account, we deduct all the expenses. In this case, we have to add it back all the non-cash expenses or non-operating expenses. For example, proposed dividend of current year, interim dividend paid during the year, transfer to reserve, deferred tax liabilities, provision for expenses, provision for taxation made during the current year, extraordinary items if debited to statement of profit and loss account. We deduct certain incomes like deferred tax assets, tax refund, extraordinary items if any credited to statement of profit and loss account. Here I would like to explain each and every expenses or income. First, take into consideration proposed dividend. Try to understand, when the company declares dividend, it is not paid in the same financial year, but it is paid in the next financial year. For example, proposed dividend for the year 2018-19 is 10,000, whereas proposed dividend for the 2019-20 is 15,000. In the year 2019-20, proposed dividend of the previous year, which is amounting rupees 10,000, will be paid by the company in this year. Proposed dividend is a financing activity of a business. It is added back to the net profit because this dividend is just proposed. There is no cash flow outflow or inflow. Proposed dividend of the last year will be payable or will be paid in this current year. When it will be paid, in that case there will be cash outflow will take place. Next concept is interim dividend. This is a dividend declared by the board of directors during the current year. This dividend is due and paid in the current year only. This is a financing activity. So whenever the interim dividend is paid, it should be deducted from the cash from financing activity. For example, if it is given interim dividend of rupees 10,000, then this 10,000 should be added back to the net profit. At the same time, it should be deducted from the cash from financing activities. Next point is transfer to reserve. Transfer to general reserve or any type of reserve is nothing but appropriation of net profit. For example, general reserve for the year 2018-19 is 12,000. For the year 2019-20 is 18,000. General reserve is a activity in which there is no outflow of cash or inflow of cash, so it is added back. But when you are adding general reserve, we should take into consideration only the difference amount, because last year we have kept 12,000 aside. This year we are keeping reserve amounting rupees 18,000, so there is a net difference of rupees 6,000 which we have to add back, amounting rupees 6,000, not 12,000 or not the amount of 18,000. After that, provision for expenses. When company makes the provision for the expenses, it is only book entry. There is no cash outflow, so the amount is added back. But whenever we are adding back the amount of provision, we should add back the amount of current year. In this case, we will add back amount of rupees 8,000 as a provision for expenses. Same case in case of provision for taxation. Provision for the current year is amounting rupees 30,000. Provision for the previous year it was 30,000. For this year it was 38,000. So we'll add back amount rupees 38,000, that is provision made for the current year. As there is no cash outflow, it will be only a book entry. Deferred tax liabilities. Deferred tax liability is again a liability where the tax amount is due but it is not paid. So this is a book entry. There is no cash outflow. Therefore, it should be added back to the net profit. Deferred tax asset is a reverse concept of deferred tax liabilities. Sometimes we pay advance tax which is more than actual payable tax amount. So it represents deferred tax assets. If it is given income tax paid, then it should be shown separately while calculating cash from operating activities. Since we are calculating net profit before tax and extraordinary items, this amount is adjusted to arrive at the correct figure. There are certain extraordinary items. What do you mean by the extraordinary items? These are the items which represent receipt or payments which do not occur during the usual course of business. These are the expenses or incomes which are not the part of or which are not the result of operations of the business. These are shown separately at the end when we calculate cash from operating activities. We deduct or add these while calculating net profit before tax and extraordinary items. So dear student, these are the certain references which I have taken while preparing this presentation. Before concluding, I would like to mention one quote here. Making more money will not solve your problems if cash flow management is your problem. So dear students, if you want to make money, your cash flow management must be very effective. Thank you so much guys.